Hello there. So in this video, we are going to be looking at the topic Commercial Arithmetics 2. We are going to subdivide the topic into 4 subsections, which we are going to look at them in terms of a brief overview and also in terms of the questions. So the very first subsection that we are going to be looking at is simple and compound interest. So we know that for simple interest, we are given the interest by the formula, the principal, multiplied by the rate, and then multiplied by the time. So the principal is what we refer to as the initial amount, and this is what you're going to be referring to throughout the topic as our principal, either the amount that is borrowed from an institution or the amount that is deposited so that it can be able to earn interest for a certain period of time. So the contrast between simple and compound interest is simply that simple interest, the principal remains constant throughout the duration for which the principal is to earn any interest. But for compound interest, the principal changes after the end of each and every duration that the amount is supposed to earn interest. And hence, the formula for finding the amount. Now, in this case, we introduce a new term which we are calling the amount. The amount is now the principal plus the interest earned. So in this case, our amount is going to be given by the principal, put in brackets, 1 plus the rate of interest over 100%. That is if it is going to be in percentage form. And then all that we put in brackets and we raise it to power the time. This is the amount of time that we are going to have invested or borrowed this principal. Then number 2, we are going to look at this topic in terms of a subsection we call the hire purchase price. So we know the hire purchase price is given by the deposit and then plus the monthly installments, and then you multiply by the number of months that you are going to have this item repaid. So basically, what is hire purchase? Hire purchase is a situation whereby you go into a shop and then you want to buy a certain item, but then you do not have the immediate cash price with you. So what you do, you negotiate a deal whereby you pay some amount, that is what we call the deposit, instantly. And then after paying the deposit instantly, you're going to repay the remainder of over a certain duration of time. And that is what is now called the monthly installments. You multiply by the number of months that you're going to repay the remainder. So that is why we say that the hire purchase price is given by the deposit that you paid instantly, and then the monthly installment, the amount that you're paying each and every month, and then you multiply by the number of months that you're going to repay that remainder. Then number 3, the other subsection we're going to look at is appreciation and depreciation. So when we talk about appreciation, this is when you take a certain asset and then that asset over a certain period of time, it increases in value. So since the asset is increasing in value, we take this as if it is also similar to compound interest, whereby now we say that the formula for the appreciation, the amount at the end of the appreciation that we are looking at, is going to be the initial amount, that is what we are calling the principal, and then into brackets 1 plus r all over 100, and then all that we raise it to power t. Then for depreciation, it's going to be still the amount after this period of time, whereby now depreciation, we are saying that the asset is reducing in value. So the value now is going negative. And so the amount at the end of this depreciation is going to be the principal, put in brackets 1 minus now the rate all over 100, and then we raise it to power the time, the period of time that the asset is depreciating or it is reducing in value. Then finally, in the 4th subsection, we are going to look at income tax. So now income tax is also called pay as you earn, and that is also what we abbreviate as pay. So here we are going to see pay with different terminologies that we are going to look at. But first of all, in this video, for simple and compound interest, we are going to look at them in question 1 and question 2. Then for hire purchase, we are going to look at it in question 3 and question 4. For appreciation and depreciation, we're going to look at them in question 5 and question 6. And for income tax or payee, we are going to look at it in question 7 and question 8. So on to our questions. And our very first question, we are being told that Mrs. Kazi deposited 15,000 shillings in a bank that pays compound interest at 12% per annum. If the interest is compounded quarterly, we are told to calculate the amount at the end of 2 years and then round off your values to 2 decimal places. And there you are to earn 3 marks when you solve the question successfully. So in this case now, we require to know that our principal is now going to be 15,000, and then our rate here, it is 12% per annum, but then we are being told that this interest is being compounded quarterly. And we know that in every year we have got 4 quarters. And since we have got 4 quarters, that means we take the interest rate per annum and then we divide by 4 so that we can be able to get the interest rate per quarter. And then now, when you divide by 4 there, we are going to realize that our R is going to be equals to 3. And then for the time, we know that still every year has got 4 quarters. And now we want to know the interest rate after 2 years. And this means now, if every year has got 4 quarters, we multiply the 2 by 4 so that we see that the period of time that we shall be compounding the interest is going to be equivalent to 8. And now we know our formula is given by the principal, put in brackets r all over 100 raised to power t. And so now we simply substitute the values of p, r, and t. And so in this case, we are going to have p 15,000 plus 1 all over 3 all over 100, and then raised to power 8. And so now, when we work out this, we are going to obtain 19,001.55, which you can say it's 19,001 shillings and 55 cents. So in our second question, we are told that a man deposits 50,000 shillings in an investment account A, which pays 12% interest per annum, compounded semi-annually. If he had deposited the same amount in another account B that pays 15% simple interest per annum, which account would have earned more interest and by how much after 3 years? And here we have been given 4 marks. So here we are seeing a combination of simple interest and compound interest in the same question. And so our plan here is just going to be we find out what interest we are going to earn in account A, and also we find out what interest the man would have earned in account B, and we can be able to know which one has got more. And so for account A, our principal is 50,000, and then our rate is now the 12% for the whole year. And since in a year we've got 2 semi-annuals, we divide that by 2 so that we see that now here we're going to use the rate as 6. And then now for the time, we are going for 3 years, and each year has got 2 semi-annuals, so we multiply by 2 so that now we can be able to obtain our time or the number of periods to be equals to 6. And now we know our formula as it is there. And then now this, we substitute the values of P, the principal, the rate, and then the time. And when we work out that, we obtain 70,925 So in that case, this is going to be our amount, or this is going to be the total amount in the account A after the 3 years. But now we want to find the interest. So the interest earned is going to be now the amount 70,925.96. We take away the principal, which was 50,000, so that we see that the interest earned is now going to be 20,925.96. So that is the interest for account A. Then we go to account B. For account B, the principal still remains to be 50,000. Then the rate is now the 15% per annum, and our time is now going to be the 3 years. And now we find the interest using the simple interest formula. So we know simple interest is given by the principal multiplied by the rate and then multiplied by the time. So here we substitute 50,000 multiplied by the rate, 15 all over 100, and then multiplied by the 3 years. And when we work out that, we are going to obtain that our interest is now 22,500. And now, so that we compare, we subtract the two interest rates for the first account and the second account. And when we subtract, we obtain the difference is 1,574.04. And so that way now, we can just be able to tell that the account that earned us more interest is now account B by 1,574.04. So in our third question, we are told that the cash price of a TV set is 26,000. Linda bought the set on hire purchase terms by paying a deposit of 6,000 and the balance by 24 monthly installments of 1,045.30. Find the compound interest per year. And here we've been given 3 marks. So what we require to know is that when we buy an item on hire purchase, the amount that is remaining that we pay in monthly installments, we pay with an interest, which in other words we call the carrying charge. So now, when she paid the 6,000, we take now we take the cash price, we take away the 6,000, and she remained with a balance of 20,000. So this 20,000 is now the amount that she borrowed. And this amount that she borrowed is what now in this context we are going to refer to as the principal. And so now our rate is what we are trying to find out here. And then now, since she's paying the installments each and every month, it means that the interest rate is being compounded after every month. And so here the time, we strictly take the time in months. So in this case now, our time is going to be 24 months. And then now, the amount that she will have paid, since she borrowed 20,000, but now at the end of the 24 months, she's going to pay now the 1,045.30 multiplied by the 24, so that we see that the total amount that she paid instead of the 20,000 that she had now been left with to pay is now going to be this 25,087.20. So then that way now we have the principal, we have the time, and we have the amount, and what you're trying to find out is the rate. So we know our formula as it is here. Now we substitute the values. So we substitute the amount, that's 25,087.20, will be equals to the principal, which is 20,000, and then 1 plus the rate, which we do not know, and then we raise it to the time, which is 24 in this context. And so the first thing, so that now we can be able to work out for R, is we divide both sides by that 20,000. And so when we divide by 20,000 on the left-hand side, we get 1.25436. And Now on the right hand side, we shall be left with 1 plus r all over 100 raised to power 24. And now, so that now in this case, we can be able to work out for r, we find the 24th root on both sides. So once we get the 24th root on both sides, the left we shall be left with 1 plus r all over 100. On the right, we shall have 1.009487. So we take 1 onto the onto the left hand side, sorry. And when we take 1 to the left hand side, we shall have that our r all over 100 is equals to 0.009487. And then now from there, we can multiply both sides by 100 so that we get the value of r, which is now 0.9487. But note, this is the rate per month. Since our time when we were working out up here, it was in months. And so since it was in, it is the rate per month, to get the rate per year now, as the question has instructed us, we multiply the rate per month by 12. And when we multiply the rate per month by 12, we obtain 11.38%. So in our fourth question, we have the cash price of a laptop is 48,000. Kiprop bought the set on hire purchase terms by paying 18 monthly installments of 3,000 each. Find the compound interest rate per year. And here we've been also awarded 3 marks. So we find another case whereby we are dealing with hire purchase, and now it is combined with compound interest. But now, in this particular case, you realize that for Kiprop, he did not pay any deposit. And since he did not pay any deposit, he took the laptop and now started paying it in terms of the installments. And so in this case now, it means our principal is now going to be equals to the 48,000, which was the cash price. And then now, as you've been doing, our time is going to be the 18 monthly installments, since now Kiprop is paying monthly and the interest is being compounded per month. And so now our amount going forward now is the total amount that now Kiprop ended up paying after he had paid the total 18 installments with 3,000 each month. And so in total, he paid 3,000 times 18, which gives us 54,000 shillings. So that way now, we know our formula as it is there. We are just going to substitute. So this implies that our amount is 54,000. And then our principal is 48,000. And then our rate is what we do not know. And it's what we are going to find out per month. And so here now, so that we can be able to work out the value of R, we divide both sides by 48,000. So when we divide both sides by 48,000, we are going to have 54 all over 48, which is now 1.125, being equivalent to 1 plus R all over 100, then raised to power 18. And so at this point, in order to get the value of R, we divide both sides by 8. We find the 18th root. We find the 18th root on both sides. So like that. And when we find the 18th root of 1.125, this is going to be equivalent to 1.006565. And this is what is going to be equivalent to 1 plus R all over 100. And so after that, we can take 1 to the left-hand side. And when we take 1 to the left-hand side, we get 0.006565. And so when you multiply by 100 on both sides, our R is going to be equivalent to 0.6565. But now, this R is for every month. This is the interest rate for every month. And we want the interest rate for the whole year. And so to get the interest rate for the whole year, we multiply 0.6565 by 12. And when we do that, we are going to obtain 7.878 So this becomes our interest rate for the whole year. So in our fifth question, as indicated in the beginning of the video, that we shall be dealing with appreciation, and also we shall be seeing depreciation in the next question. So this question tells us that at the beginning of the year 2004, Kamau bought two houses, one in Thika and the other in Nairobi, each at 3,750,000. The value of the houses in Thika appreciated at the rate of 12% per annum. Then part A, we are told, calculate the value of the house in Thika after 9 years to the nearest shillings. And then you get 2 marks. Part B, we are told, if after n years the value of the house in Thika was 8,290,055, while the value of the house in Nairobi was 8,822,271. So Roman 1, we find the value of n, 4 marks, and then Roman 2, we shall find the annual rate of appreciation of the house in Nairobi. And there now we also get 4 marks. So in this scenario, if we start with part A, whereby we want to calculate the value of the house in Thika after 9 years, we still follow our formula, whereby we said for us to get the final amount, in appreciation, we use the formula for the compound interest, because the rate of appreciation is after every year. So this means the principal for every new year is different. So we take the formula amount is equal to the principal in brackets 1 plus r all over 100 raised to power t. And so in this case, we substitute now accordingly. So our principal here is the initial amount, so which is 3,750,000. So we substitute on behalf of the principal, and then 1 plus the rate. Our rate, we've been told that it is 12%, so 12 over 100. And then we raise it to power 9, which is the time we want to find out the value of the house. So in this case, we are going to obtain 10,399,045 shillings. So this is the value of the house after now it has appreciated at a rate of 12% for 9 years. Then part B, Roman 1, we take the same formula now, and we'll find that now in this part B, we want to find the value of n, whereby n is the time taken for the house to appreciate from the original price now to the new price, which we are saying that it is 8,290,055. So this is our amount. So this amount is equivalent to the principal, so the original amount of the house, which was 3,750,000, and then now put in brackets 1 plus now the rate of the house in Thika. The one in Thika was appreciating at 12%, and then now we raise to the power n, the number of years. So here we are required to solve for the value of n. So for us to solve for the value of n, we divide the right hand side with 3,750,000, and whatever you do to the right, you also do it to the left. So when you divide to the left, you're going to have 2.2107, and then on the left, you're going to have 1 plus a 1.12 now raised to power n. If you take 1 plus 12 over 100, you get 1.12. So now at this point, we just want to find the value of n. So in order to get the value of n, it means n is a power, we introduce logarithms. So when we introduce logarithms, you're going to have the log of 2.2107 being equivalent to n log of 1.12, like that. And so to get the value of n, we divide by the log of 1.12 on both sides. And when we do that, we are going to find that our n is now going to be equivalent to exactly 7. So that way, we have gotten the number of years that the house appreciated for, that it can obtain a value of 8,290,055. So then, in part Roman 2, we are told we find the annual rate of appreciation for the house in Nairobi. So for the house in Nairobi now, the amount that it amounted to now was 8,822,271. So we take that amount and we say that this was obtained by taking the original amount, which was our principal 3,750,000, multiplied by 1 plus the rate which we now don't know. So we put R, and then we raise that to the number of years it appreciated, which was 7. And here, for us to solve for R, first we divide by 3,750,000 on both sides. So we do that. When we do that, on the left we get 2.3526056, and this is going to be equivalent to 1 plus R all over 100 raised to power 7. And so at this particular point, for us to get the value of R, we find the 7th root on both sides. So we get the 7th root on both sides. And when we get the 7th root on this left-hand side, we are going to have 1.130. And on the other side, we are going to have 1 plus R all over 100. And so now, when we evaluate this, our value of R is going to be exactly 13%. And so this is the value that the house in Nairobi appreciated with annually. So in our sixth question, we are told Gibson bought a motorbike for 75,000. Its depreciation rate is 12% per annum. What will be the value of the motorbike at the end of 6th year to the nearest shilling? And here we've been given 2 marks. So here now, we are going to realize that our formula is now the amount is going to be equivalent to the principal 1 minus the rate all over 100, and then you raise to the power our time now. So we substitute these values. So to get the amount, we take the principal, which is now 75,000, and then we put 1 minus the rate, which is now 12 all over 100, and then we raise it to power time, and our time here is going to be equivalent to 6. And so simply like that, we find the depreciation value, which is now 34,830 to the nearest shilling. So before we solve the questions on income tax, we need to look at some terminologies that we use when it comes to income tax. So note that income tax is a tax that we pay, is paid by employees, and that is why it is called pay as you earn, or otherwise abbreviated as payee. So in this case now, the first terminology that we are going to look at is what we call the gross pay, or the total income. So this total income is given by the basic salary, and then we add all the allowances that this particular employee receives. Then number 2, we'll talk about the taxable income. This is the amount that is considered when now this employee is being taxed. As we know now, for an employee earning 1 million, they're not taxed the same amount as an employee earning 20,000. So in this case, the taxable income helps us to determine in which bracket do we consider this employee for taxation. So how do we get the taxable income? We get the taxable income by taking the gross pay, we take away all the allowable deductions, and instead of the allowable deductions, in some cases we shall have allowances that are exempted from taxation. In some cases, we have situations whereby an employee is paid some allowances that are not included when it comes to the calculation of tax. So these allowances will not be included in the taxable income. So allowable deductions may include housing levy, the nominal rent paid by an employee, and other specified deductions that in this particular context might be required. So those allowable deductions, you make sure that you take them away from the gross pay so that you can be able to obtain the taxable income. But in case in a question there are no any allowable deductions, then the gross pay becomes the taxable income. The third one that we are going to look at, we are going to look at it in two parts. Part A is what we call the gross tax. So the gross tax, this is the tax calculated from the set table of taxation. So this is the total tax calculated from the set table of taxation. So once you get to the table of taxation and you calculate the tax that you're going to obtain from that tax bracket is what we call the gross tax. Then part B is the net tax, or in other words, we can call it the tax payable. So the tax payable, here we take the gross tax and then we take away all the reliefs available for the employee. So sometimes we have automated tax reliefs. Sometimes we have calculated tax reliefs from maybe a contribution to an insurance policy that an employee has. And we need to take away all these reliefs from the gross tax so that we see what amount of tax should this employee pay, or what is the net tax for this employee. And then finally, the fourth terminology that we look at is what we call the net salary or the net income. So the net income is now we take the gross pay and then we deduct all the deductions that this employee makes. So in this case, we are going to take away all the deductions that this employee makes, whereby we also include the tax that we calculated that they are supposed to pay. It's good to note that it is not all deductions that are allowable deductions. Not all deductions are considered to be allowable deductions. For example, loan recovery deductions are not considered allowable. For example, maybe money that you contribute to a SACCO, those ones are not considered allowable deductions. But now those ones come to the bracket where we talk about all deductions. So in this case, it is good you be very particular on which deductions are considered to be allowable. So on to our seventh question, now on income tax. We are told that income tax rates for income earned were charged as follows. So there in the table we have got a column for the income in Kenyan shillings per month and the rate in Kenyan shillings per 20 shillings. So there we are told that a civil servant earns a monthly salary of 19,200. His house allowance is 12,000 per month. Other allowances per month are transport that 1,300 and medical allowance 2,300. He is entitled to a family relief of 1,240 per month. So we want to determine A Roman 1, his taxable income per month. So we say that taxable income is given by the gross pay, then we take away allowable deductions or any allowances exempted from taxation. So in this case now, we first of all calculate the gross pay, and the gross pay is going to be given by the basic salary, 19,100, and then we add all those allowances. We start with the first one, house allowance, 12,000, and then we go to the transport allowance 1,300 and the medical allowance 2,300. And when we sum this, we are going to get 34,800. So this amount is the gross pay. So then we check, are there any allowances that are exempted from taxation here? There are none. Are there also any allowable deductions? There are none. So in that case, this gross pay also becomes our taxable income. So in this context, this is our taxable income, and this is what now we are going to carry to the table, that now we can be able to calculate how much tax this person is going to pay. So then now, in the Roman 2 of part A, we are being told we calculate the net tax now. So to calculate the net tax, first of all, we calculate the gross tax. So we take our taxable income and we take it to the table. So this table, when we check the amount 34,800, it is going to be included in the band from 30,000 to 36,000. So this is the fourth band. And so now this is where our amount is. So we taxed this employee from the first band, the second, the third, and also the remaining amount in this band. So now we start with the first band. The amount in the first band is 8,400. We multiply that by 2 shillings for every 20 shillings. So because our taxable income here is in shillings, then we have to put it at 2 shillings for every 20 shillings. So now that one gives us 840 shillings. So this is the tax that we are going to tax this person for the first band. And then for the second band, now we are going to take now first 18,000, the maximum in the second band. We take away the maximum of the first band so that we see how much taxable income is in the second band. So in this case, when you do the subtraction, we are going to get 9,600. So this is the amount that you're going to tax for this person in the second band, or in the second bracket, from 8,401 to 18,000. So we take that amount, 9,600, we multiply by 3 out of 20, that we get the tax that this person is supposed to pay in that band is 1,440. Then we go to the third band, and in the third one, we are going to subtract 30,000 minus 18,000 so that we see the taxable income in that band is 12,000. And since it is 12,000, so we take 12,000, we multiply by 4 out of 20, that we see the tax that this person pays is 2,400. Then we go to the fourth band, and this is where our money is. So we are not going to complete the whole band up to 36,000. So we take from where our taxable income is, that is 34,800, we take away 30,000 so that we get the taxable income for that band is 4,800. So we take 4,800 and we multiply by 5 all over 20 so that we obtain 1,200 as the tax that this person shall pay. So now, to get the gross tax, we take 840 for the first band plus 1,440 for the second band, and then plus 2,400 for the third band, and then we take 1,200 for the fourth band, and so now this sum is going to give us 5,880. So this now is what we call our gross tax. But our question here requires the net tax. So to get the net tax, we take the gross tax, which is now 5,880. We take away the reliefs available for this employee. And the reliefs available for this employee is 1,240. That is the family relief. And so when we subtract, we are going to get 4,640. So that is the net tax at the end of it all. And then, part B, we are told, in addition, the employee has the following deductions. The following deductions were made. So NHIF 230, service charge 100, loan repayment 4,000, cooperative shares of 1,200. So we want to know his net salary per month. So now, in this case, now note, these deductions were not allowable deductions. These are regular deductions. They are not exempted from taxation. So in this case now, to get the net salary, we will now take the gross pay for this person, whereby now we know that the gross pay is now the 34,800. Then we take away all these deductions. We start with the tax that he is supposed to pay. So that is 4,640. And then we sum that with 230 plus 100, and then plus 4,000 plus 1,200. And then when we deduct everything from the gross pay now, we are going to obtain 24,630. So this 24,630 is the net salary that this employee received for that month. So in our eighth and last question, still on income tax or pay, we are told that the table below shows the income tax rates in a certain year. So note here that in our table, annual taxable income in Kenya in shillings and tax rate in percentages. So note that the taxable income is for the whole year. Then now we go during that year, Currenta's annual gross tax in the sixth band was 108,000. So this was the tax that he was supposed to pay in the sixth band. So the sixth band is the band above 840,000. That is the last band. So here in part A, we are required to determine Currenta's annual gross tax. So this means if he had been taxed up to the sixth band, he must have been taxed from the first band up to the last one. But you will note that in the first band, the tax rate in percentage is 0%. So this means there was nothing that this person is going to be taxed in the first band. So taxation starts from the second band. So in the second band, the taxable income that is there is now the maximum 300,000. We take away 144,000, the maximum of the first band. So the taxable income is 156,000. And here we are taxing at the rate of 10%. So 10% is equivalent to 0.1. So 0.1 times 156,000, we see that the tax there is going to be 15,600. Then the third band, when you go to the third band now, the taxable income there, we subtract the maximum for 68,000. We take away 300,000. We get 168,000. So 168,000 is the taxable income in the third band. So we tax that at the rate of 15%, which is equivalent to 0.15. And when we tax that at that rate, we get 25,200. We go to the fourth band. In the fourth band, we subtract 648,000. We take away 468,000. So that we see the taxable income in that band is 180,000. And we tax that at the rate of 20%, which is equivalent to 0.2, so that we obtain 36,000. That is the tax in the fourth band. Then we go to the fifth band. Again, we get the taxable income. So we take the maximum 840,000. We take away the maximum of the fourth band, 648,000, so that we obtain 192,000. So we tax this 192,000 at the rate of 25%, and we are able to obtain 48,000. So this 48,000 is a tax in the fifth band. So now, in order to get the gross tax, the annual gross tax, we take all these taxes in all these bands and we sum them together. So we start with the first one, 15,600, the second one, 25,200, and then the third one, 36,000, and then the fourth one, which is 48,000, and then we also take the last one, that is the gross tax in the sixth band, which is 108,000. So we sum them together to get 232,800. So this 232,800 is the gross tax that Currentus was able to pay for that whole year. Then in part B, we are told if he enjoyed annual relief of 21,000, determine his monthly net tax, that is the payee. So here now, because we have the gross tax already and we need the net tax, we just take away the relief. So that's now when we take away the relief, we obtain 211,800. But then we want per month. This was annual, so we divide by 12, so that we obtain that the net tax per month was 17,650. Then we go to the part C. In part C, we are told Currenta had a basic salary of shillings X per annum and enjoyed non-taxable allowances that is equivalent to 45% of basic salary. So this means in our taxable income, the allowances are not included. So we want to determine Currenta's gross salary per month. So in this case now, first of all, let's get the taxable income in the sixth band. So in the sixth band, the taxable income, let it be X, multiplied by a rate of 30%, which is 0.3. So that now we obtain this 108,000, which was the gross tax in the sixth band. So when we do that, we are going to find out that our X is 360,000. So this 360,000 was the taxable income in the sixth band only. So in order to get the total taxable income for Currenta, we add now the 840,000 that we reached at when we were in the fifth band, and then we add now with the taxable income in the sixth band, the 360,000. So that now we obtain that Currenta's total taxable income was 1,200,000. So now from there, we can be able now to multiply this by 145%. So that now we also include the non-taxable allowances in order to obtain now the gross tax. We have simply added the 45% on top of the taxable income, which was the gross pay, and now we want to obtain the gross salary, but we want it for every month. So we divide that sum by 12. So 1,200,000 multiplied by 1.45, that is multiplied by 145%, and then we divide by 12. So that now we obtain this amount is going to amount to 145,000. Then from there now, this is the gross salary for Currenta in that particular month per month. Then part D tells us that the following deductions were also made from Currenta's salary every month. Cooperative shares 8,000, cooperative loans 12,000, pension scheme 4,000, union dues 2,000, and we want to determine Currenta's monthly net salary during that year. So in this case, we have seen that the gross salary was 145,000. This is what he was receiving. So now what we need to do so that we get the net, we take away all the deductions that Currenta is making, that we see how much remains with Currenta at the end of the month. So we take now the 145,000, and then we take away the deductions. We start with the tax. The tax he's paying per month is 17,650. We add now the deductions, 8,000, 12,000, 4,000, 2,000, and all of them together we subtract. So that now we obtain that Currenta at the end of the month he was receiving 101,350.